Here we are looking at the markets and vertical trends, those companies that have the strongest momentum and have pushed out exponential charts that seem to just be going higher and faster every single week. Plus, we also look at a very interesting insight that goes all the way back to the GFC lows, something that Gary's just picked out and seen that they square out consistently, something I'm really excited to look into. It's a good report that you've got this week coming in towards the year end, and we say good morning, Gary Glover from Novus Capital. How are you?
Yeah, I'm good, Chris.
I was pretty
Yeah, what?
excited with what you were saying before the recording, and I got all excited and just, no, we have to stop and start recording this. So
Yeah, it's funny. I sort of like, obviously the market's getting a bit frothy there. So over the weekend, I was sort of looking at, it was just obviously the last couple of weeks to talk about the Dow, S&P, and the NASDAQ. They're all sort of getting pretty close to, they're all, the Dow's already hit 45,000, but the other two indices are now within 1% of squaring out those major ranges there. So myself, I wonder, I knew that it's pretty important, squaring the ranges there, but I thought, I wonder, I'll go back and look at sort of square the previous bear market out and then just see how relevant it was there. And, so as I went through it all, I thought, gee, every high since the GFC is squared out from that range there. And I thought, gee, this is more important than I thought it would be. So, and, just told me that just got to careful fall into a lull here of thinking we're going to rally through the end of the year as well. I looked previously too. We've had a few early December highs and had a few late December highs as well recently. So we haven't actually got to January, which is normally the what we this sort of seasonal trade, the Christmas rally normally takes you through the first week of January here, but that hasn't sort of been the case in recent years. So just got to be careful with that. So may not happen here, so yeah.
well, you've talked about the squaring out of the ranges. We've got the standard individual charts for the NASDAQ, S&P, Aussie, and Dow Jones. Before we just get into the technical aspects of it, the squaring out of the range, is that what you're talking about where we have the high, the low, that becomes the range, and then once we surpass that previous high, whenever that ends up being, it's a certain percentage or a Fibonacci level of this old range that it ends up breaking out on top of. Is that the squaring out you talk about?
Yeah, that's right. So I looked basically back at the 70s, Chris, to the NASDAQ, because obviously it hasn't been around that long. And even that sort of 70s bear market, it actually squared out and went to the 161.8 in 82 before it had a pretty decent sized correction. So the 161.8 is pretty important level. I knew it was important for the S&P 500, which had seen so many highs on the S&P 500, which are squared out that level. So I was curious whether the NASDAQ had sort of something similar. And so when I looked through the NASDAQ historically, this is a big level, the NASDAQ as well, when we look at historical sort of precedent. So it's just sort of a bit eerie here that we've got them all squaring out at pretty important marks here all at the same time. And we do know election years tend to sort of, markets tend to sort of stay buoyant into the end of the year, and not too many big corrections along the way, it's sort of pretty much gone to script as well. So, and to me here, the cycles are just telling me to be pretty cautious in the first half of 25 here. So it's just got me a little bit, it might just be a little bit of a cooling off here, maybe more of a consolidation period there. But I do think we'll get a shock in 25 in that, in the first half, more than likely in the second quarter rather than the first quarter. But it's just getting pretty stretched here. It's just, when I square those previous ranges out, wasn't sort of so much the size of the correction that followed there, it was how long it took to actually get back above that point. And like a lot of those squarings there where someone took, 6 months to break above there. Someone took a year, someone took 2 years before they break back above those levels. So it just can be a mark which drops the market for an extended period of time from getting any further. So that's probably the greatest relevance there. But just look, the NASDAQ's had a pretty good run here. Market's looking pretty frothy to me. So I just when I'm looking through some of the stocks there, I mean, I was, as I sort of said last week there, Chris, and I was interviewed actually yesterday by Ausbiz as well. So the same thing is that unless, if resources and the materials and commodities don't step up here, I think our market's going to be in trouble because commodities look oversold. They need to bounce there, but the financials and the growth, everything looked, accelerated. Everything looked overpaid. Everything looked extended. And so to me that, the growth sort of shares and the financials look vulnerable for a decent pullback. So really need materials to sort of stamp. So I was sort of happy to see that China sort of stimulated last night, and then BHP and Rio had a nice bounce there, because that is going to hold us up there. Maybe we can still go a bit further here, Chris. Maybe our market can hang on, but look, we were going to need resources to come to the party there. So which is great that it has done. Maybe that, there's quite a few areas of commodities that have been a bit underwater here. So hopefully they can do a little bit of lifting here and take us a little bit higher here. But we have pulled back here up back to that 20-day moving average. Might have even cut up today, but just interesting here. I think the financials are, well and truly overpaid here, so there's some risks there. But just not nice to see the commodities are doing some lifting there.
So you've talked about the Aussie, you've talked about that rotation. The question because the squaring out's amazing in the United States in those indices, and we'll have a look at the S&P and the Dow Jones in a second. But you've talked about the Aussies, you've talked about the banks' high valuations. The growth shares we'll get to in a second, because you have some staggering charts later in the report. But the index here that we have on the Aussie, the XJO, the top 200, do we have any similar thing with the squaring out, or it's a different case for the Aussie, not the same phenomenon that you've observed with these three US indices?
Yeah, no, well, look, we have tagged that October 23 low. So basically from the sort of high, that sort of 7,600 high to the October low, we've actually hit that. We actually tagged that level there last week. So that's always been my minimum target for us to expand up to. I'd love to see whether we can get back up to this October 22, which is a probably more important low there for this index. And that's a little higher there. That's sort of, 87, 800 are sort of up around that level is sort of where I'm, hoping we can get to. So again, we do need the resource segment there to sort of do some lifting here and take us there. So so it's nice to sort of just need other segments to have a bit of a cool off. Other areas of the market to do a bit of lifting there. That's what we've seen so far. That's why our market has continued to keep grinding higher there, because when one sector cools off, another one steps forward. So that's the positive side today. He was seeing some of these commodities bounce here.
So with the ASX rotation, that may help us sort of mirror out these movements that you're talking about, where this red box is sort of the midline, and then this red is sort of one distance. This drop down October 23 lows we're kind of the same distance that is from the red box. We are currently sitting out on the Aussie and tag last week. And to get to that higher range, the 8,800-ish area, they'll be extending the October 22 lows from the red box, but to the upside. So that's sort of those ranges in a way. But the interesting ones was just going back to the GFC, that we looked at with the S&P 500, the NASDAQ, and so on. So this is different in the sense, I'll just scroll back up to the NASDAQ for us to remember. It's running at 161.8 of that range that it previously had.
Yeah.
With the S&P 500, you've got 200% here. So this is the whole range, the old high down to the low, and then once it finally breaks out above that old high, we're almost that same distance away. Is that 200% mark that you're talking about?
That's right. So the squaring of a range is normally pretty important. We're seeing a lot of stocks here. I think, we'll show 360, which is another stock. We'll show that squared out as well. But a lot of sort of stocks and indices do square those ranges out. And they can be sort of resistance levels which hold the market for a period of time. So they can be important resistance points as well. So, the interesting thing, when I went back and looked, when the last sort of really decent bear market was the GFC, was sort of 07 and 09 there. So that was like 1576 high down to the 666 low in 09 there. That was like a 909 point range there. So if you square that range out, the 2015 high was the 61.8 expansion of that range. The 2018 high was 150% expansion of that range. 2020 high was the 200% expansion of that range. The 2022 high was the 350% expansion of that range. And 2024, we're very close to basically a 500% expansion of that range. So very similar, 6123, 6140 here. We're so close to a lot of squarings all at the same level here. And so I sort of wondering, okay, how relevant were those squarings there in the past there? I mean, what was most interesting was with that 15 high, apart from having a 15% correction there, it took a year to break back above that level, Chris. And the 18 high had a 20% correction. It took 6 months to break back above that level. The 2020 high, which was the 200% expansion, again, took 6 months to break it, had a 35% pullback in the market. It's a pretty sizey one. 2022 high, which was the 350 expansion, took 2 years before it broke back above that level. And they had a 27.5% correction. So, yeah, I mean, you had some fair corrections there. So 15 to 35%. So, sizable. But probably what's more important there is at 6 months to 2 years, we might spend under there, or, doing a lot of work here. So this tells us that this market's getting very extended here, and at probably an very important expansion in terms of, from a technical perspective. So look, some people don't believe in technicals and don't believe in all these Fibonacci's and expansions there, but I just tell you to go back historically and look at how meaningful they are. And they often are very, very meaningful. So just, no doubt valuations are high, markets are extended here. Everyone's pretty buoyant. I can't remember the market being this extended and yet everyone being so bullish. Normally it's a little bit more cautious. There seems to be, there's a euphoria here. Probably the most speculative thing we've seen in the last 10 years in the market there has just ticked over to 6 figures in the last week, Chris. So I've got 104,000 there, the Bitcoin there. So that, if that's not a sort of sign of how frothy this market is, I don't know what is.
Well, two quotes that have come from previous interviews is you're always looking at the probabilities. So whether people like and follow the technical analysis and these Fibonacci levels or not, if you put them into a model and look at the probabilities, they're just miraculously strong and statistically significant. And the other one is, well, with Bitcoin running up, it's different this time. And we had that with the commodity super cycle, and we've had it so many times before. So just markets have this history of repeating themselves, which leads us back to this squaring out of ranges and the cycles that you talk about. So to round it out, one more cycle and one more set of fib levels. The Dow Jones, I'm just going to highlight this little difference here. So the Dow Jones, the chart, there's just the candles, the last two candles. We've got the S&P 500 and the NASDAQ sort of edging up, or the NASDAQ exploding up towards that 161.8 level, its respective target. The S&P 500 going up to the 200. The Dow Jones, it's pretty much touched it, tagged the 200% level, and it seems to have sort of moved with less confidence. It's sort of bounced a bit.
Hey, it has been one of the strongest indices so far as well, the Dow. So in recent times there, and you've got the 3 shallow trend lines, so you still do have a pretty strong trend there. That's the only sort of disclaimer I'll say, that this market is pretty strong. It's got momentum behind it. So I guess of course it can go higher here, but it is interesting here that it's tagged that 45,000 there a couple of weeks ago, Chris, and hasn't been able to break it yet. So still seem to be sort of finding some strong resistance there. So look, in the past they've been very relevant. So that's all I'll say there. It's just I think there's a relevance there. We're sort of coming into end of year. I think sort of Nov and January were the 2 months that I thought were probably the greatest risk of maybe finding a bit of a peak here. So not far away here from a early Jan. We might congest a bit more here. The S&P 500 NASDAQ might grind a little bit higher here, but we're so close to all those markets here, hitting really important resistance levels all simultaneously. So that's got me a little nervous there, to be honest with you. So yeah, some risk here.
All right. Well, there's definitely risk on the indices. We want to have a look at the next layer down. We're going to have a look at those really exponential movers in a second, but you've talked about the rotation within the Aussie market, banks being expensive, high valuations on financials. And then stimulus last night with BHP. Obviously, they won't show up on today's report because you do these reports on the weekend and share them with clients on a Monday. What's happening with BHP? Why is it important, and why the weekly chart?
Yeah, look, they've just sort of, I've had that, impulsive bounce, probably pull back twice as much time here, and we haven't gone to a new low. So that's sort of, and it has sort of shown some sign of strength the last couple of weeks there, but without really get going here. So, just felt like this is a make or break week for the market personally, for our market. So, if we've got any chance of getting to A800, we're going to need materials to sort of, to hold up here and show some strength there. So, luckily for us, I think BHP is up to 42 today. So, it has had a pretty nice bounce here. So that's quite good. Maybe these resources can sort of rally here into year end, or maybe a bit further here and maybe hold our index up there.
Okay, well, definitely required, because if the materials are tanking and the financials just hold flat, it's obviously going to drag the market down. So for every dollar the BHP and Rio are falling, it means the banks need to make up for it, and to carry the market higher, that's even more heavy lifting.
Yeah, some of the banks have already pulled back a bit here. So I noticed ANZ, got a bit of a hit yesterday after having a few down.
Yeah, CEO.
Yeah, a couple of down weeks as well. So they've had a bit of a pullback here. So they sort of undercut the previous sort of swing low, so that they've had a fair correction. So it doesn't all sort of happen at once. So you'll get the first leg down, and you'll get a bit of a bounce, make a lower high here. So, considering how long that this bull market has been on its financials and how overvalued those financials have got, I don't think that's just going to roll over strip away. I think it's going to be a bit of a time to, to congest and distribute there. So, I expect to see some distribution now. I noticed the S&P last night, Chris, had its second distribution day in the last 4 or 5 days. So we normally see 4 or 5 days cluster before we see
a rollover.
Yeah. So it's interesting. We've seen 2 in the last 4 or 5 days. So I expect we need to see a few more here. So I think it'll take a little bit of time here. So I think the market's probably going to still hang on here. Just be cautious coming into year end here. I'd definitely be tightening up here. I mean, probably the commodities is probably the segment I think looks, potentially oversold here, and maybe can have a bounce here. But I think the other segments there definitely look pretty stretched there. So there's a few pockets there still look pretty good to me, but there's plenty that look pretty oversold, overbought and pretty extended here. So I guess got to be cautious there.
Well, we all know those banks that have been at historically high PEs. Commonwealth Bank, the most expensive bank in the world, was a conversation having this morning with the fund manager, and why just hard to hold from a fund manager's perspective, which then leads us to, well, you've talked about the indices. Do we get to 8,800 on the Aussie? Do we hold the line? Do we end up falling? If those financials roll over and come back to even moderate valuations, the market's going to tank. And the only help that we really have is what you've been saying, is that if the financials do come off the boil, we really do need the materials to kick in. And that's sort of why you're looking at what's happening with some of the larger cap minerals on the ASX, to understand how that basing's happening. Because if they don't have a good basing pattern and the financials fall off, we've got a really hard time ahead of us on the Aussie. So mineral resources, it's in that space. What's happening, and is it similar to BHP? You're seeing sort of positivity in the last couple of days, or how do you read it?
Yeah, it's funny. I saw actually last night, I'm sure it's UBS there, but UBS, I think, upgraded 4 lithium stocks there, went to overweight. I think might have been IGO, PLS, CXO, and one other, I think, blank quite bit there could be. But yeah, definitely sort of 4 stocks. They thought, just definitely sort of seeing some value in that sector. They thought, we've now sort of seen like a lot of this, a lot of companies sort of put operations that were sort of care and maintenance as well. Prices had a fairly large correction there. So just got all the classic sort of signs of the bottom in that sort of, in that area there. So you take a while, you sort of build here, but I like mineral resources there. I think, we've sort of got this massive volume there, Chris, on that, over the last sort of few months there. So this looks like accumulation to me. I know this is going to get a descending wedge there. We've had a bit of a breakout there. What I do like was we've had a couple of days up, now pulled back 4 days and haven't gone to a new low. So, which is sort of sitting outside of that little wedge as well. So we've sort of got a wedge break, which is positive, and now we've sort of got twice as many days down, hasn't gone to a new low, which is sort of positive. So we have kicked up today out of that range, which is a good sign there. So some positivity, some green shoots starting to come through there. So hopefully this can push up here.
Well, the green shoots, but Santos is an interesting subject in itself. You've noticed that it typically has these deep seasonal lows in early December, which you've highlighted on the chart for us. So obviously a weekly chart, we come towards the end of it, we can see December low, December low,
Yeah.
possibly a December low.
So I think 3 of them are actually on the same date, which is, I think it might have been December 6th or December 12th or something there. There's a few of them were on the same dates there. So, here we go. But I mean, like I know sort of seasonally that September through to December is normally the weak spot for the kind of crude oil and stuff there. So oftentimes, sometimes if the market's really overbought going into sort of September there, that's always a risk of some downside into December. But see so many December lows there and in this oil spot, and it's one, Chris, there. I don't know every analyst that I've listened to around crude is so negative. Supply glut, so just everyone that's got, thinks that crude's going to break down here. I'm pretty bearish there. So I don't know anyone who's positive this sector at the moment here. So, so that tells me the market's placed on one side here. So, when I see such a contrarian view like that, it's usually when you sort of do get a snap back no one sees coming. So, I just think it's pretty interesting here that this one has sort of come back down here again in new lows there. So it's definitely one to sort of watch it. I wouldn't just sort of jump in and buy it early, but probably wait for some sort of low risk setup here. But definitely want to keep an eye on here, just with the way it's set up seasonally and on the consensus bearishness there. It's just got the classic signs there of another low here.
Well, we go from an oil producer, energy producer, to an oil consumer in the sense that flights consume energy, but they're more of the travel company looking in the travel space. It has rounded the bottom. It has sort of turned that corner. It did it with the 0, 1, 2, 3 low, and then has sort of that explosive movement. Now it's really just congested, sat tight on sort of these previous highs over here. How do you interpret what's happening with corporate travel right now, and has it been this successful 0, 1, 2, 3?
Yeah, I mean, so far it has, So we've got a bit of a base there. We've sort of cracked through the top there. What I really like there, Chris, is the last 2 or 3 weeks, I can't see any volume on that. So after having a pretty good run up here, this pullback there, I just haven't seen any selling come in here. So, so far the pullback has stayed pretty tight, stayed pretty high in the range. Just haven't seen any aggressive selling there at all. So, so if you get along here, I sort of think, look, I know it's sort of still a bit early here. I might use a bit more time up here, but I haven't seen any selling here so far. So I think that's pretty encouraging.
Nice. Well, it's good to see that congestion as well. So not much selling, but as you say, like loose is for losers, but tight, you really want those tight patterns. So as it tightens up, is that a compelling component that makes you look like, well, you might even add to it?
Yeah, that's right. Yeah, I was sort of one that I've sort of missed a couple of times there. So but that sort of stays pretty tight in here. But definitely add to this one for sure.
Okay. Well, Macmillan Shakespeare, a different part of the market, but you've looked at and noted that the SG fleet had its the takeover bid received. It's still sitting really tight in this range here, right down near the lows. And once again, we're talking about tight movements as opposed to these wider movements. What's happening with Macmillan and what's caught your attention?
Yeah, just the tight price action. Obviously, we've seen SG fleet be bid for in the sector. I've also noticed that SIQ has sort of had a bit of a pop in the last few days as well. So popped out of a sort of similar sort of structure there. But when I was looking at the stock there, I was thinking, it's 12 times and the yield's close to 10% here. I thought it's pretty attractive. I mean, it hasn't really moved much there. It's weird here. These sort of high growth momentum sort of shares seem to be sort of getting all the limelight there. These sort of maybe it's not safer, but these sort of more classic value shares there have sort of lost it. They've lost it a little bit. So there's plenty of these sort of high yielding kind of boring stocks there that are that have been languishing or just been going sideways for a while here. So just thought this was pretty interesting here. Just the whole price action's tightened up here. It could still break down here, don't get me wrong. But I just thought it looked pretty encouraging now. So
Very good. Well, we go into another one, which is EZZ. So life sciences, different part of the market, different industry, different sector. It has had the rally. So we're looking at this. This is a daily chart. Most of them are weekly that you're looking at, but it's had a decent rally, percentage-wise, massive. Then it cooled off, congested, rallied again, congested, rallied. We've fallen, but what's the significance of where we've fallen to?
yeah, I mean, like a couple of things there. Obviously, anyone who looks at sort of momentum shares there, it's sort of that 50-80 rule is just so pertinent in the market here. We talked about earlier there that like a lot of those leading names there, when they have those really big high momentum moves there, we know that sort of 80% of them will come back 50%, and then 50% will potentially come back near 80% as well. So we just know once they've had a pretty big move, they'll have that pretty big pullback as well here. So we've seen, I think Ordinate's come back 72%, MP1's come back 57%, that Neuron Pharmaceuticals come back 54%. This has come back about 53%, the EZZ. But what's probably interesting here is it's come back to the old low there in that sort of that July, August there. So that's oftentimes they'll often pull back and sit on top of previous highs there. So that's probably the first big technical level for the stock there, which is just over the 50% level. So, I mean, it's interesting sort of stock there, Chris. It's in that sort of, buy life sort of area. So do a lot of the, not anti-aging there, but the sort of, I guess a lot of the nutrients and vitamins around that sort of area. So it's had a pretty strong growth here. Definitely a segment, kind of growing there. So in that sort of health and well-being space, it's just had some really strong growth there recent, in the last year or two here. So the stock's had a great run here. Still has some pretty decent returns sort of going on. So just where they can sort of keep growing and up. So it's not, wouldn't say it's the biggest, doesn't have the biggest market cap as well. So when they get a really big market cap there, that's when makes it harder to sort of keep those returns humming away. So this has still got got a chance of actually maybe recovering and having another move here. So this level might want to see some pull here, but probably one to watch here over the next week or two, just see whether they can actually hold that previous high there and maybe build from here. So it's one that I thought maybe if, if it has a little bit of a B-wave break, it might be one to have a look at.
Well, you've talked about the strong momentum within EZZ and definitely massive gains coming from 50 cents to $5 in the space of a year. If we thought that was a strong momentum chart, we look at the next one, which is Pro Medicus, and you mentioned it's hard when they get a high market cap to keep climbing. Pro Medicus has managed to do that. This is a weekly chart, so for the comparison, we need to really highlight that's the weekly chart. But this is just a staggering chart in itself. We're looking at $10 here to 270 over market cap's grown a bit. We could say many reasons why it's in the chart, I could guess, but tell me why you picked this chart, why now, and what is it that you're looking at in this chart that's really caused you to put it in this week's report?
Yes, a lot of people say we don't get, the really high momentum movers there, or these sort of high PE stocks there, Chris, that, like the US gets. But, you look close enough, there's been quite a few in the last year or two sort of sneak in here. So, Pro Medicus, as much as it's a great company here, this thing here is really accelerating. We're literally on that weekly there, we've got like 5 or 6 accelerating trend lines. I don't think I've actually ever seen one with so many. I think the CSL in its early days might have had like maybe 5 accelerated trend lines before it had a big correction there. So this one's had a phenomenal move here. It's only on about 338 times, Chris. So, it's not that, PE's made it too much, but, when they start getting up like that, it's just, look how fast that move. It's literally, since July here, we've gone from 120 to 270 here. So we've literally doubled in the last 4 or 5 months. So, that is getting vertical. What really stands out to me is that volume in the last week here. So when you've been running, you get that massive volume there. And then, I think the founders sold 1 million a couple of weeks. I know still got plenty left, but if founders are selling some here, it's always a sort of sign that can getting a bit frothy as well. But this is, I reckon this is a contender. But we know those leading stocks, once they're done, 80% of them are going to come back 50%. So I think this is a contender to come back 50% from here. So, I think, I'd be pretty nervous about this one. I'll definitely be tightening up here. I think, so we've seen quite a few of the leaders that topped in March have some pretty decent pullbacks. So, I think there's a good chance it'll come off quite a bit here. I mean, the last little swing low there is around about 180. That was a little pause there, but the last acceleration took off really around that 120, 130 zone. So that's usually where they'll often come back to where that last acceleration point from. So if I was long this one here, I'll be giving myself a pat in the back here, but I wouldn't be, wouldn't be leaving it alone here. I'd be, personally be selling a little bit in the strength there. I'd probably be running a stock personally. I do think this stock's a contender to have a 50% drawdown from here.
Now, we have heard that before. We have seen that. And you got a bit of flack the last time you said that with Drone Shield. You looked at it and said, oh, look, accelerating trend line. This is where it could come back to.
Sentinel was the other one too. I think I called that one as well. Look, PME is obviously a better company than Drone Shield and Satire, but I'll say that Satire and Drone Shield did not get as vertical as it's, did not have a vertical trend that got this type of move and leverage in a short period of time here. So, just look at that chart. There's risk there. No one's going to argue with me that there's not risk there that's sort of cooling off there. So you could easily cool off 30-40% this share easily. But I think it's a contender to come back 50%. Yeah.
Yeah, it's got every possibility, every chance to do it. And we've read books, Vinny talks about these sort of pullbacks. We've read William O'Neill talking about it as well. And we've seen it with Amazon. I think you said it pulled back 96%. So it has happened. Doesn't mean they won't be a great stock in future. Just means they wear a bit of pain. Now, there's another example that you've got in this week's report, Hub24. Not the same caliber as Pro Medicus, but we're still looking at here on a weekly chart. We're going back. So we're out of COVID lockdowns. It's only sort of 12 months ago. It was sort of $20, $25. And then here we are, we're approaching $80 at the moment. So massive run. It is a large company. The market cap has grown at the same time. So why is it in this week's report?
Yep. Only 131 times, pretty cheap compared to Pro Medicus. So, but look at that run there, Chris. That's, you're talking about, this stock was $35 here. At the end, we're basically the start of the year. So, we've basically more than doubled here. Now the index hasn't doubled. So this is a high beta share here. So oftentimes what I mean by that is if the market goes up 10%, a high beta share might go up 20% or 30%. So this one here is going to be really tied to market fortunes, because obviously the market goes up in value, then the funds under management grows as well, and then you're managing more money in it. And the market likes momentum. It also likes FUM to grow as well. But if the market cools off 10, 15, 20% here, then that FUM is going to shrink. Momentum is going to be a bit negative as well. So again, this is probably another contender. I think again, like Hub, Netwealth are great companies there. I think Netwealth's on about 90 times, so not both high as Hub there. I think this is a contender there to, what are we, sort of 78? So we could easily come back down to $38, $40 there. Look, maybe this one only comes back 35, 40%. But again, it's another contender to come have a pretty sizable correction here if the market cools off there. So everyone's just so bullish here at the moment. It's just got me nervous there. Having squared all those range out, Chris, got me a little bit negative at the weekend. So, I'm often a bear at heart just because I do love trading the short side of market sometimes as well. I think people get locked into one view, but in terms of bullishness, I can't remember the market being as bullish as we are at the moment. this is bullish I've seen this, of any market in many years. I mean, I got to go back to maybe like something like an 07 there, where you just had to be long resources at that stage. There, if you didn't have BHP and Rio in your portfolio, you're a mug at the end of 07. But yeah, it's just you're just a little euphoric here. So just all I'm saying is be cautious here. We've got all these indices all hitting, very close here to ranges. I think, probably got a little bit further to go here, but just starting to see a few cracks there. Starting to see a few of these sort of growth stocks start to peel off here. So some of them should come up. We've already seen hubs already 360 have already had a little bit of a pullback here. Few decent red bars down. Probably the biggest corrections we've seen in the last 6 months from a dollar range point of view. So yeah, just some caution here. Yeah, if you're long, say stocks, I'm sure plenty of people would. I'd be just tightening up here. Don't want to see these things sort of crack below these moving averages. I mean, like something like I think hub here has stayed above the 20 since August this year. So that's humming along here. So I know William O'Neill basically, as soon as he saw the growth stocks cut the 50, he'd be out guaranteed. So he wouldn't let he wouldn't hold any of these momentum leaders if they crossed below the 50-day moving average. So that's all I'll say. I'll follow the great man's words. That's what we should be looking at that's if your stop's not there, you obviously don't use them.
And just to clarify, you're not saying that you're selling right now. You're saying that there are alarm bells and the market is telling you a few things. There's the confluence of all of the squaring out of the ranges of the US indices. We've got these massive exponential movements for the high beta companies sitting on historically high earnings. And there's a lot of consistency and market analysts are all going the same direction. So the consensus is very narrow in the sense that we're going one way. You're saying that these are alarm bells. It's not that you're selling the portfolio and you're going to cash today, but you're just being extra vigilant of your stops and to look for distribution days and other alarming signs. Is that a fair summary?
Yeah, that's right. Yeah, I'm still got a few positions on at the moment. So, but yeah, I'll, I just think we're, I know we're sort of seasonally, we're sort of coming into the year. Obviously, we're the Christmas rally here. Just got to be careful though. Just after looking at the weekend, Chris, I just really put things in perspective for me. But got to be a lot more cautious there moving forward here. And really, only the commodities was probably I think maybe commodities, some of the healthcare stocks, maybe some of the travel stocks looked okay, but a lot of the other segments, growth, financials, they're just they are vulnerable here for some decent falls there. I know seasonally the small caps tend to sort of perform pretty well through to January, March from here as well. Like so there's they've actually been solid here, small caps. So maybe they can, maybe some of the money's going to come out of these growth and financials there. Maybe it's going to move into materials and maybe into smalls tonight. There's a few season money obviously will move somewhere else, but there's plenty of stocks here that are pretty frothy, so yeah. Hopefully we'll see that rotation in our market, and our market can sort of still hold up here if the financials come back, but don't expect those financials to roll off quickly. I just think they'll probably put up a fight here. I think the high momentum movers, like the PMEs and the hubs and the 360s, those stocks will come off pretty quickly. If you look at Ordinate, MP1, Nuix, and pharmaceuticals, just if you look at all those sort of leaders in the last couple of years, when they've cooled off, they've come off pretty quick. So I think they will come off pretty quick here, but I think the financials there, I don't see them having the meltdown until probably the second quarter of next year. So I just think that's going to be a bit of a grind back here. But, Combank clocked 28 times there last week. Is that right? Trend, the yield's 2.9%. I mean, geez, who's buying it up there, Chris? That's all. It's got to be ETF oriented. It's like the weight of money going in. People don't understand ETFs. ETFs, if you buy that ETF basket, if you keep buying the same ETFs, then the ETF holders have to keep buying the same stocks that are in those APIs. So that's sort of fueling that sort of thinner rally there. As soon as the market stops here, and money starts coming out, then they're going to keep selling the same ETFs and the same stocks that are in those ETFs. So it's going to fuel it both ways here. So that's why I sort of think, there's been a rise of ETFs there, but I think that's led to maybe, because you think about the leaders there, obviously the Mag 7, because you can have, you have US ETFs, you've got, Australian ETFs, each country will have their own ETFs and they'll have those same stocks in their basket there as well. So the world's gotten easier to get access to those, all overseas funds here. So it just makes those leaderships get, so many more people in them.
More concentrated kind of.
Yeah, definitely. Yeah. That's probably one reason for it. But yeah, I'm just curious to see what happens here when the market starts to unfold the other direction. They got to come out there. You remember that oil ETF?
Oh, we pushed it negative.
Yeah. So people don't understand that. That's if you've got a LIC, a managed fund, it's a closed fund. It can't get any bigger. So it's dictated by what's in the basket and goes up and down. An ETF, if it's a popularity contest. If that ETF is more popular, it could potentially grow. It could double in size in a month or two if everyone wants to invest in that ETF. But then once it loses popularity, Chris, it could halve in size, in 3 to 6 months as well. So they are not just representative of that basket; they are represented the flow into that basket as well. So how popular or negative the basket is. So most people think they're getting a true basket of those stocks, a correct weighting. But if you go back and look at the history of those ETFs, they
are tracking it.
When it turns negative, just say the sector turns down, say 10 or 15%, the ETF can come off a lot heavier than that because it's gone up a lot more with the weight of money going into it, and it will come off a lot heavier on the way down with the weight of money coming out of it. So just be careful, ETFs. Most people have this presumption that they're getting a true basket that's actually in that ETF. They're getting that basket, but they're getting it with with a popularity sort of taste as well. So that will fuel its upside and it will fuel its downside too if it gets a lot less popular.
And as you're talking about this, it's evident in a bullish market, but a lot of people just see that as the success of the markets and the companies. It's extremely evident when the rug gets pulled out from underneath it, it falls fast. And the companies that are exposed to the ETFs, the indices, you just see this flood of selling come into the market, just wave after wave after wave every single morning. And it's evident that there's the ETF pressure versus the others. Now, we'll wait until there's a bearish market and we can see that. But that's sort of, I guess you've seen that in the past, haven't you, Gary? That's sort of.
Yeah, we just haven't seen the sort of money that's gone into ETFs in the last 5 years, this as well. So I actually think that, I think once we go through the next bear market, I think ETF's going to be a lot less popular. The thing, just kind of reminds me, sort of like a warrant has sort of got, had its time in the sun as well, and then they cooled off, and then it was like a warrant. You can basically make one side of the market, you don't make two. Like the thing about options is, if the options market, you can be a buyer or a seller. You can choose which side you want to be on. So there's a fairness to that. So you can, depending on the price, you can choose to be a buyer or seller. So it's more open there. The warrant issuer is made on one side, so it's a bit different. But ETFs are a little bit one-sided as well. I guess I challenge anyone to go and look at a bearish ETF and a bullish ETF in the same instrument, overlay them for 12 months, and see what the results are. Because they should, if they represent exactly the same basket, then they should. Once you take fees out, they should have the same result in it. If you invested in both of those, you should have the same result at the end of the time. But I guess if you go back and do a 6-12, 2 years, I think you'll find a fair disparity there. If you're asking your question, you'll be asking yourself, why is that?
And yes,
This flow of money has a massive
edge. but
Yeah.
it tends to be more than those other costs that are spoken about. So yeah, that's a very good insight, and we'll look for that, especially when we see distribution days like you mentioned. That can be sort of the canary in the coal mine to really start looking for these things and be wary of ETF sell downs. And just to finish out on, you've talked about these exponential charts. We'll put a link on screen to the video of Friday's interview where you're covering the top momentum companies that look a lot like Hub and look like Pro Medicus. And to that end, we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.